All right, good afternoon, everybody. Welcome to our Lunch and Learn class today. We have a great presenter here for you, talking about our some tax tips for our small contractors, hosted by the City of Charlotte Contract Development Program. We want to thank you all for your time. Uh, I know it's a midday and everyone's getting their lunch on, so we greatly appreciate it. So let me go over some housekeeping slides to Right. So for today, since this is an intimate class, we want to make sure that you are able to participate by either putting your questions in the chat, raising your hand with the Zoom feature, or if you have a question in between the class, feel free to unmute yourself politely when the speaker is done talking to be able to ask a question. But please participate as much as you can. This is a great resource for you to learn and educate yourself before you do your taxes, or if you've already done your taxes, you could get tips for next year. And at the end of today's class, we'll have a quick survey link for you, just like this today. I'll be posting the link in the chat, and you can scan the QR code when you're ready to do our survey. And here is our contact information. If you have any other questions for other future classes, or if you have any questions in general, feel free to reach out. This will be displayed at the end of class as well. Now I'm gonna kick it over to Nicole for her to get started and introduce herself.
Awesome. Thank you so much, Jason, Michael, for inviting me to be on today's webinar. Let me just reshare my screen with you. One second. So I love that we have an intimate setting. So I'm Nicole Davis. I am the founder and CEO of Butler Davis Tax and Accounting. I also own Groundworks Contractors. I have a small contract construction business myself, and BD Payroll. We're based out of Atlanta, Georgia. I have a team of 12 on the accounting, tax, and payroll side, and a team of about 13 on the construction side. So today's topic is about tax tips that every small business and contractor should know. All right, so let's jump right into it. I want this to be an interactive session. So definitely, if you have a question about anything I discuss, go ahead and raise your hand. Also throw a question in the chat, and we'll make sure that I get those answered as quickly as possible. So thank you, Myra, Josh, and Naima for being here. And because you all showed up for the webinar, I get to tailor the presentation more to you. So if you have anything that you want to discuss specifically, feel free to do that, okay? All right, so tax tip number one. So one of the major tax tips that a lot of businesses get wrong and get right, and I'll explain what I mean by that, are the deductions. So ordinary and necessary is always the name of the game. So what does that mean? That pretty much means the IRS allows you to deduct expenses that are both ordinary and necessary for your business. For instance, if you have a construction business and you decided you want to buy an airplane, well, the IRS is going to look really closely at your return because that is not an ordinary and necessary purchase for a construction company. However, if you bought a dump truck or an excavator or small tools, anything related to the construction side of your business, that is not looked at as closely as something that does not relate to your business. Also, think about the deductions that you can take just throughout operating your business. This includes materials and supplies, your vehicle expenses, insurance, of course, a home office if you don't have a physical commercial office. And I know that a lot of construction companies work out of a home. They don't have a commercial space that they're leasing. So think how you can take your deductions from a home office. And if you have any questions on that, I can go a little deeper. Marketing and advertising, and of course, professional services. These are just a few of the deductions that you can take in your construction business. And just remember, just because you bought it doesn't mean it's deductible. So what does that mean exactly? That means some things aren't deductible by your business, and your tax professional is the best person to give you advice on what you can deduct and what you cannot deduct. So a great example would be, let's say you hired, you decided to take your customers to a football game or a basketball game. The IRS recently wrote into law that you cannot no longer deduct entertainment expenses. So just because you bought it doesn't mean you can deduct it. So how can you get around that? That's why working with a tax professional is is recommended because generally those are revenue generating activities when you're taking customers out to wine and dine to you, and it may not be deductible as an entertainment expense, but it can be deductible as a marketing or advertising expense, something that only someone that knows the tax laws in and out could advise you on. So I always say deduct what you can support, because one of the worst things I see with small business, especially small contractors, is that they deduct everything. And when they deduct everything, it kind of puts them in a topsy-turvy position, because let's say you're relying on your business for your household income or your livelihood. Well, if you deduct everything and you later want to go out and get a loan or buy a house, well, if your P&L shows a negative net income, banks and lenders are less likely to lend to you because they don't think you have sufficient cash flow. Also, make sure you only deduct what you support, because in the case of an audit, you want to make sure that if the IRS questions a deduction, that you can support it 100%. So keep your receipts, and we're going to talk about that a little later. Keep your receipts, keep anything that you put in the face of your return as a deduction filed away securely somewhere. Now, we talked about deduction. I'm going to briefly mention something that is not on this slide, and that is your revenue. So just as it is important to deduct every deduction that you legally can, it's also important to recognize all of your revenue. That is one of the main red flags the IRS looks at. Are you including all revenue that you earn in a particular year? So generally, you can file as a cash basis taxpayer or an accrual basis taxpayer. Cash means you recognize revenue when it comes in, when the cash comes in, and you expense when you pay something out or cash goes out. That's cash basis. Accrual means you recognize the revenue as soon as the work is done and you invoice the client. So let's say you had a job, you did the work, you completed, and now you invoice the client, and it's December 1st. So you invoice the client $100,000 on December 1st, but they don't pay you to January 1st of the next year. Do I need to recognize that revenue? It depends. If your cash basis, no, because you didn't get the cash in the door before the end of the year, which is December 31st. If your accrual basis, yes, because you recognize revenue at the point that you earn it and you bill your customer for it. So again, don't miss out on key deductions, but also make sure that you recognize revenue. Now, there's something in the tax called constructive receipt, and I've seen this often with clients. Constructive receipt means when you recognize revenue, or when you get a check, for instance, from a client. Let's say you invoice the client December 1st for that $100,000. On December 29th, they not only mail you a check, but it arrives to you by December 31st. You take it out the mailbox, you open it, and you say, oh, I got $100,000 that I need to include in my revenue this year. Do I deposit in the bank or not? I would tell you now, go ahead and deposit in the bank, because it's called constructive receipt. That means the IRS wants you to recognize the revenue as soon as you have physical control of those funds. A check means you have physical controls of those funds at that time. To get around that, a loophole is, especially if you're cash basis, is don't bill the client until the following year. So that way, you know, they won't send you a check at the end of the year. Because remember, your clients or your customers are also trying to take as many deductions as possible. So of course, they're going to try to pay everyone that they can by the end of the year, so they can take a deduction and get that money off their books, or get their revenue off their books. All right. All right. So that was a lot I just talked about in the first 7 or 8 minutes. Any questions about deductions, revenue, constructive receipts, how it works, or any expenses that you're considering deducting, but you're not quite sure if you should? We'll just open the floor up for just a few.
I have a question.
Yes.
Sorry, Josh, go ahead. Go ahead.
No, can you speak to the criteria for a home office?
Yes, definitely. Thank you, Josh, for that question. So The criteria from home office is that it must be an exclusive use of space in your home. So for instance, if you have a 3-bedroom home and you use one for your home office, meaning it's not used for a bedroom at all, then you generally can take a home office deduction. If you also use it as a guest room and / home office, that's not an exclusive use of that space. So that's criteria number 1. Second, you only can take the business use percent of any expenses related to the home office directly or indirectly. So for instance, say you had a home that was just easy math. You had a home office, you had a home that was 1,000 square feet total. You had a home office that was 100 square feet total. So you pay rent in that home, you have a utility, I can't even speak today, utilities and water. So how much of that can you take as an expense for the home office? Well, you have to take 100 divided by 1,000. That's just 10%. So you can take 10% of your rent, your mortgage interest. Now, I didn't say mortgage payment, just a mortgage interest. If you have a mortgage, you're paying instead. Real estate taxes, utilities, water. That's your business use percent of the home office. That's indirect costs. Direct cost means anything directly related to that home office space. So let's say you had a roof leak and it leaked directly into your home office and you had to fix that leak and it cost you $2,000. Well, you don't have to take 10% of that because it's related directly to the home office area. So you could take that full $2,000 deduction because it's a direct expense. Does that make sense, Josh?
Yes, thank
right.
you.
Perfect. All right. I think Ada had a question too.
I did, and so I understand what you mentioned, 100%. It is related to the home office or to the house,
Okay.
but a little different.
Okay.
Last year, I was browsing around and I
Mhm.
heard something where you could possibly deduct a lot of your expenses for your house
Mhm.
if you put that information in your operating agreement, or if you design it in a way where the owners can obtain certain benefits out of the company,
Mhm.
and you can bypass the rules of a percentage for the house. I haven't been able to find specific information on how to do that, but
Mhm.
that's what I would love to do. I would love to cut my mortgage out of my business expenses because it is a benefit as the owner.
Right. Right. Okay, so that there's some truth to that, but not really. Not in the sense that you put it in the operating agreement and you can automatically deduct it. So there's something called the Augusta rule, and it also depends on how you organize or how you're taxed. So for instance, S corps have to have an accountable plan in place to where they can use their home for up to 14 days as meeting space. It cannot be more than 14 days as meeting space outside of the home, but that's inside of the home that they could rent anywhere else in the area. So you can literally have your business lease that space in your office up to 14 times a year and pay a lease amount that's comparable to the market. So let's say that you're an S corp, you want to lease back to the business a space in your home for, and it could be for pretty much, it could be for board meetings, it could be for like company gatherings, it could be for strategy sessions, but it has to be 14 days that are not consecutive. So like once a month for the most part. And you can say, well, if I were to rent this space anywhere else in the area, it would cost me about $1,000, right? And then you can say, okay, I am going to charge my business $1,000 for the use of my space through an official lease agreement and use that to take a deduction for it. So it works in some cases. In some cases, it does not work because, again, there are certain criteria that you have to meet, and that's a lot to go through on the call. But that is a way that you can take more of the home office deduction versus a straight percentage.
Thank you.
All right, so let's go to tip number 2, documentation is your best friend. So I talked about this briefly in the last slide. It's very important that you keep your receipts and invoices organized. Of course, if you're not using formal accounting software, I definitely recommend that because it allows you to create your financials at year end for your tax pro so that they can easily prepare your business tax return. Also, you want to document every expense, no matter how small. Something I noticed early on is that when people initially start their businesses, they forget all of the deductions or things that had to happen before they open their doors. So because of that, they miss some key deductions early on that, because I didn't have anything formal in place to track those amounts. So definitely, if you don't have a formal accounting system in place, just grab an expandable binder. And people like to do it by month. I like to do it by category. So with that expandable binder, you can put in your receipts or documentation by categories. At the end of the year, you can take all of that information, total it by category so that you can create a manual profit and loss if you're not using formal accounting software. So again, documentation is going to be your best friend because it's going to save your butt every time something is questioned by the IRS. It's also going to save your butt to make sure that you're only paying what you're legally supposed to pay with the IRS. I always tell clients, deduct everything that you legally can to reduce your tax liability. If you can support it and I'm okay putting on your return, you're good to go. There should be you should not second guess what is deductible or what you can support as long as you have the receipt for it, as long as you have some written proof that you actually use the money as you said that you used it. One thing I noticed that a lot of small business owners, especially small contractors, that they'll take money out of the bank like an ATM transaction and they won't let their accountant know what that money was used for. So in most cases, your accountant has no option but to categorize that as a distribution, which could hurt you. So with that, if you take money out of your bank account and it's cash and you're using it for business, it's best to take that cash receipt, write on it what you purchased with the money, and then get an official receipt from the vendor to attach to that ATM receipt. So to prove that, hey, I took $300 out, but I didn't use it on myself. I actually used it to buy business supplies, or I had to give it to a vendor because they don't accept credit cards. They only accept cash. So that's one way you can kind of clean up your documentation to make sure that you're properly have support for everything. And I always say today it takes more brains and effort to make out the income tax form than it does to make income. I'm not sure how many of you were in business during COVID, but so many tax laws came down the pipeline during that time that our tax laws just exponentially increased. So for a tax profession, it was a lot for us to have to sift through and kind of advise our clients. So I know it was a heavy burden on small businesses to sift through because first, they don't write tax law in plain English. It's always very technical jargon, something that most people do not get into. And for tax profession, we even take additional courses just to understand some of the language in the tax business as well. So again, reach out to your tax professional if you're not sure what or how something needs to be documented so they can make sure that you're okay. All right, any questions about tax tip number 2? We're good? All right, so
I have a question. Good
yes,
morning.
Tiffany, good
I was trying to
morning.
find my unmute button.
Okay.
So in your experience, what do you feel like is the best software for us, like on the go to use for
Yep.
documentation on the fly? I know, QuickBooks exists, Zero exists.
Yep.
What is your experience with the clients that you have that they're saying is best?
So we definitely love a few different apps for receipt capture. QuickBooks does have as a receipt capture tool where you can use your phone and snap pictures of the receipt and then it sends it to your QBO file. I haven't toyed with the Zero one quite yet. There's also something called Dext, D-E-X-T. It's a receipt capturing tool, and it's especially useful for those that have job costing that they have to do, because then you can not only stamp the receipt, but you also can include job costing information so that it gets fed into your formal accounting system. If you need something for mileage, I definitely recommend Mile IQ. So that's a huge deduction that a lot of people don't realize they can take. For me, mileage is a deduction that keeps going. It's like the golden deduction because no matter the car, you always can take as much mileage as possible as a business deduction. as long as as long as it's actually business miles. Whereas if you take actual expenses on a car, you only can take it so many years because eventually the deduction is going to run out. And with the IRS, they say you can always go from mileage to actual on an asset. You can never go from actual to mileage. So I say those are just a few of the apps that we do recommend to some of our clients.
Okay, thank you.
All right, so how many of here have employees? So I want to make sure I definitely center my attention on those tax tips that matter to you. Anyone has employees here, or anyone here put themselves on payroll yet? No? Okay, not yet. All right, so if you are considering hiring employees, tax tip number 3 is definitely navigating those employment taxes. So you want to make sure you differentiate between employees and contractors. There are specific rules that the IRS has laid out on how to classify employees versus those that are contractors, and you don't want to get caught in that little trap. Whereas if you classify someone as a contractor, they have the ability to actually tell on you to the IRS if they feel like they should be an employee. So again, just make sure you follow those specific rules to avoid having someone kind of dime you out. Withhold and pay the correct amount. So payroll taxes is one of the things the IRS does not play about. That's my next point. Payroll will get you in trouble just because it's a trust fund penalty, meaning the IRS is entrusting you to collect funds from your employees and pay that to them. I have seen so many businesses that take the funds from the employees and never pay it to the IRS. So the IRS considers that illegal, and they will come after you more than anything. So I would say before they come after you for income taxes, they'll come after you for payroll taxes. So keep that in mind when you're navigating your employment taxes. Also, it's best to use an outsourced company like a payroll company that will handle all of that for you so you can have peace of mind. They're usually very affordable. There are so many different options available out there. So just do a little research before you decide, but do not try to do payroll on your own. All right, any questions about hiring, payroll taxes, or the trust fund penalty? Nope. Oh, wait.
Yeah, I guess I don't know about the trust fund penalty.
All right, so trust fund penalty basically says if the IRS comes to you and says, hey, there's an issue with your payroll account, meaning you have not been depositing those payroll taxes on your prescribed schedule, and they've deemed that you have taken those funds and used it elsewhere, they're gonna penalize you. And usually that penalty is 100% of the payroll tax. So this is why I say they do not play about
I got it. I just
okay.
didn't understand the name. Okay,
Okay.
I got it.
Yeah.
Thank you.
Okay, sure. Yeah, but the penalty is 100% of the payroll tax. So I said, do not play with the payroll taxes once you start hiring your employees. All right, tip number 4, stay ahead with, someone have a question? Yes.
Before you move on, talking about employees.
Yes.
So as a, young, nimble company, sometimes 1099 employees are an option. Would you say take an employee on or 1099 has a better tax advantage?
That depends. So if you're going to have someone be a contractor, independent contractor, or 1099, you got to make sure that they pass the sniff test. So what does that mean? That means that they set their own schedules. They invoice you for payment. They track their own time. So they don't really depend on you to tell them what to do or how to do it. Now, if you want to have full control over that vendor or person, then it's best to have them as an employee. And from a tax standpoint, independent contractors, they pay their own self-employment taxes, while an employee only pays half of the payroll taxes and the employer pays the other half of it. Does that answer your question?
Yeah, so you said 1099 is better. Thank you.
I didn't say it was better. I just said you got to weigh both the options. All right, so tax tip number 4, stay ahead with your quarterly taxes. So if you heard about estimated tax payments, this is what this tip is all about. So we have a pay-as-you-earn system. So if you ever work for someone and they issued you a W-2, you know, you got your paychecks, whether it was weekly, bi-weekly, monthly, and they withdrew income taxes out every pay period. So you're paying as you earn. Businesses are a little different. So the IRS has established a schedule of pay as you earn as well. So their schedule is a little wonky, meaning your first estimated tax payment, which is coming up next month, is April 15th. And they want you to take your income minus your expenses and that profit. You take your profit times your tax rate, and that's your estimated tax payment you need to make to the IRS. If you have a loss, no payment is due. And so you have to follow this schedule based on the IRS dates. So April 1st to May is just 2 months. You run your P&L for 2 months. You see what that profit is to multiply by your tax rate, and you make that payment June 15th. Then it's June, July, August, another period. And then the last pay period of the year covers 4 months. So September to December 31st, and that's not usually due until January 15th of the following year. So you want to pay your estimated tax payments because you want to avoid those year-end surprises. So that's especially true if you don't have a regular bookkeeper closing your books every month. A lot of times, small businesses, they get to the end of the year, they say they get their taxes done, the tax pro says, well, you owe so-and-so. And they say, wait, how do I owe? I don't have any money in the bank. Unfortunately, there are some non-cash transactions where there are cash transactions that don't hit your P&L. So you owe because you have a profit, even though you may not have the cash. And that's a whole other subject we can talk about later. Keep your cash flow in check. So you want to make sure you're paying something towards your estimates if you have a profit in your business. And of course, pay those throughout the years and pay them on time, because there is something called an estimated tax late penalty that you want to avoid if at all possible. All right, any questions about the quarterly taxes and the payments?
Nicole, I got a question for you.
Yes.
I know you talked, there's a simple formula you just talked about to calculate that. Do you happen to have a worksheet? Because I know some of our small businesses have been in the situation of having that surprise and giving them a tool to, hey, this is something you need to do quarterly, just to check out your
exactly. I don't have a worksheet, but I can definitely find one and send a resource that you all can use. This is very simple. Like you said, you just take all your revenue. You don't have to take all your revenue. You take all of your expenses, deduct those out, and whatever that bottom number is, it's going to be positive. You need to make a payment on that. If it's negative, you don't make any payment. But definitely, I can send like a short resource for you.
Perfect. That'd be helpful.
Okay. Any other questions? All right. All right, tax tip number 5, unlock savings with tax credits. So this is something that's probably not talked about among small businesses, because a lot of them are not aware of the tax credits available. So tax credits are the direct deductions of your tax bill, rewarding you for certain business practices. So you want to know the difference between a tax credit versus a tax deduction. We talk about deductions a lot on the first tax tip slide. So a tax deduction gives you a % reduction in your tax liability. A tax credit gives you a dollar for dollar reduction in your tax liability. So you want to try to find as many tax credits that you're eligible for as possible. So what are some tax credits available? So you got the research and development tax credit, you got the work opportunity tax credit, you have the disabled access credit, new markets tax credit. There's something for childcare services if you provide that to employees. And of course, if you have health insurance, that's also a tax credit for that. So again, tax credit is going to give you the most bang for your buck, because against a dollar for dollar reduction, where a tax deduction is only going to give you a % deduction based on the dollars you spend. And I always say, don't spend money just to take a deduction. Save that money instead, because you can use that towards your estimated tax payments versus buying something that you may not necessarily need in your business just to get a deduction. All right, so any questions about any of the deductions I talked about? If you want to know more about any of them, I'm happy to go a little more detail about them. Okay.
I would love to know a little bit more about the research and development. What kind of what kind of research and development can be included in that?
All right, great question. So generally, research and development credits are for those that bring about something new related to their industry, for instance. So this one is a little harder to get just because there are so many layers of testing that must be done in order to qualify for it. So let's say, for instance, Pilar, what type of business, what type of construction company do you have?
We do programming for the design of the visualization of automation control systems.
All right, awesome. All right, I smile because that actually may qualify for research development credit. So if this is like software you're developing in-house, that means you are researching and developing something new for the industry. So in that case, the cost associated with developing that software for you to sell or offer to others could go under a R&D study. So again, it's all about creating or develop something new for the industry that's considered research and development, and you can get a credit for that. And there are generally a couple of ways the credit can apply. You can get it for payroll taxes, or you can get a direct deduction of your tax liability on the tax return if you have a profit that you're going to be taxed on. So I definitely say whoever your CPA or tax professional is, have them look into it for you just in case you actually qualify for it.
Okay, and how much is it, like a percentage on something? I mean,
yes, it's a very complex calculation. Like I said, there are layers of testing that must be done first in order to make sure you qualify. And then there's a calculation that's done by the research and development. They call it a team because there are people that specialize in helping companies get these research and development tax credits. And then there are forms you need to file with your tax return in order to claim the credits with the IRS or with your state. So
thank you. What about the work opportunity tax?
yeah. All right, so the work opportunity tax credit is for those that are considering hiring. And there are certain groups of people that if you hire for within those groups, you'll get a credit for the wages that you pay them. So it allows them to get back to work where they normally would not have the opportunity to, and that's why they call it the work opportunity tax credit. And there is a list of different protected classes that applies to, like one being federal ex-prisoners is one, for instance. So again, it's a list of, I'll send Michael a list of what all of those are so that he can provide it to you. And then like I said, if you're looking to hire from one of those categories, and then you're able to get that credit.
Thank you.
All right, so tax tip number 6, your future matters, save for retirement. All right, so I love this tax tip because at the end of the day, like, what are we all doing this for? Hopefully we're doing it to build up a nest egg so that we can retire after we put in however many years in our business and our profession, and we can live a good life later. So contributions can be tax deductible. So generally it results in a deduction for business or personal taxes. You want to explore all your options depending on how you're organized. If you're working solo versus if you have employees, you want to choose the best option for you and your company. A few options are the SEP, we have the solo 401k, and of course there are IRAs and then Roth accounts. Generally, Roth accounts do not provide an immediate tax benefit, meaning you can contribute to a Roth, but you cannot deduct it in your tax return. So Roths are after-tax accounts, meaning you build it with after-tax money and it builds interest-free so that when you pull it out later, it's not taxable. That's one of the major benefits of Roth accounts. And of course, always contribute something, even if it's just a few dollars a month towards your retirement. It's better to put something in than nothing. So because there's a concept of compounding that happens. So yeah, you may think, well, I only got $100 to put in this month, $100 put in this month. That's better than nothing, because there are so many small businesses that have absolutely nothing saved for retirement, but it's like a piggy bank. If you just put a little in at a time, it starts to build. Then eventually you can smash that piggy bank open and use whatever funds are available for retirement. All right, any questions about saving for retirement?
I have a question.
Yes.
So I have a small business company. Is an LLC running as a corporation. So I've been able to use a separate account.
Yeah, good.
Which is fantastic. Now I'm thinking in the future and in retirement, and I was wondering how does the Roth work as a company or on the company side? if I were to contribute to a Roth to an employee, would that be deductible like a SEP IRA? So I'm thinking in the future, like what would be the best option?
Right. So Roths are not tax deductible accounts. So that's something to keep in mind. So it's better to contribute to a traditional IRA. I think there's something called a simple SIMPLE. It's very similar to a SEP IRA, but it's for individual retirement accounts that are sponsored by employers. So look into that versus Roth. Roth accounts are more individual accounts. And again, it's used with after-tax money. So any money you put into a Roth, do not expect to get a deduction for it on any type of return.
Okay, thank you.
And that's good you're doing a SEP, because SEPs are a little tricky, especially when you start to hire employees, because SEPs are fully employer-funded accounts, meaning the employee does not have any skin in the game. I always prefer 401ks because at least it's the employees that's contributing, and then the employer can match. Whereas a SEP, if you start to grow your business and you have an employee, you have to contribute to the SEP. If you contribute for yourself, you have employees and they meet those requirements, you also have to contribute for them, and they never have to contribute anything. So just keep that in mind. All right. Now we're our last tip, then we'll just open the floor for more questions. All right, tax tip number 7. When in doubt, of course, consult the expert. So tax laws are constantly changing, as you're well aware. And you want to make sure you're working with someone that you trust, someone that's going to keep your business and your taxes in compliance. I always say if you're not sure what to do, just reach out to someone, reach out to your tax professional, ask them before you do anything related to your finances, especially if it affects you from a tax standpoint. Always file your returns on time. That's something else that a lot of small businesses don't do because they're scared that if they get on the IRS radar, that they're gonna get penalized. But if you file late, you're gonna get penalized regardless. That's what's called late filing. So I would rather file on time and have to owe if I owe versus not filing on at all. And eventually they catch up with you. And now you got late filing penalties on top of late payment penalties. Okay. So again, don't go it alone. Like especially your tax professional you're working with, we want to make sure that you're succeeding in your business, making sure you're staying in compliance with the IRS, making sure that if you have employees, able to pay them, making sure your cash flow is well. But also, again, you have to make sure you stay on top of your taxes, because that's one way that the IRS can come after you. I say, don't take that as a precaution. I said it because people are really scared of the IRS, but they are a lot more accommodating and forgiving than people realize. A lot more accommodating and forgiving than people realize. But they just want you to get in compliance. Once you're in compliance, they're happy to work with you on payment plans, on offering compromises if you're not able to pay a large balance. They're happy to work with you on a number of arrangements that allow you to stay in compliance and to keep paying them, because all they care about is you paying them. At the end of the day, that's all they care about. Also keep in mind too, if you are a company that does work as a subcontractor, these other companies are probably submitting 1099s to the IRS on your behalf, saying they paid you a certain amount of money. The IRS has all the information already in their system. They're just waiting for you to submit the return to match it with that information. So if you don't file thinking you're getting away with something, eventually the IRS is going to file what they call a substitute return if they have enough 1099s or income from you. And the substitute return is a return where they take all the 1099s that someone filed towards you or your business, they create a return for you. The problem with that return is that it has none of your deductions in it. It just has all your income, and they tax all of that income without deduction. So now you get hit with this bill that's 100% not accurate, because again, it doesn't take into your full span of your business. So again, always file on time. If you're not sure what your income is, you can always put a transcript to see what is filed in your social security number or what is filed in your EIN, so that you make sure you report all of your income. Is go back to my first slide. Always report all of your income. That's the best way to avoid trouble with the IRS. All right, now to recap, we did The 7 tips, of course, know your deductions so you can maximize things like equipment, vehicle expenses, and home office costs. Keep very good records. If you're planning to hire, make sure you understand how employment taxes work. Always outsource that piece of your business. Pay your estimated tax payments on time. If you're profitable, pay something, even if it's not all of the amount that's due. You want to see if you're eligible for any tax credits. Of course, save for retirement. Every little bit helps. And if you have questions or need help, it's best to reach out to someone that can assist you. All right, so now I'm going to open the floor for questions about any of the tax tip or just something you want me to kind of confirm or deny for you. I'm here to do that as well. So
I have a question.
yes.
Okay, so how do you know when to get a W-9 from a subcontractor or a company doing work for you? Because when I think about it, I have, companies that are bigger than some of my subs that I know should be filing taxes, anytime, whatever.
Yes.
So how do you know when to get them?
When to before you pay them. That's a general rule of practice with subcontractors or independent contractors you're working with. Before you cut them a check, you ask them to send you a W-9 first. So if you're just engaging them, say, hey, we have standard paperwork we need you to complete to set you up as a new vendor, include that W-9 with that paperwork. So that way you'll understand how to handle them when it comes time to process your 1099s. Because there's nothing worse trying to get all the information in January when 1099s are due.
Okay, then the other question. Okay, so still 2 questions. So for like larger companies that I do business with, am I still requesting W-9s from them too?
Yes, you're requesting W-9s for every single person that you give money to for services. Yes, absolutely. Now, here's the thing though, you want a W-9, but you may not issue them a 1099, but you won't know that until you get the W-9.
Okay, so then when I get it, what am I looking for to determine if I issue them?
Great question. Let me see if I have a copy of a W-9 that I can share on my screen really quickly that will.
Oh, maybe. Okay, no, you tell me. You tell me.
All right, yeah. Let me just pull one up really quick, and I can kind of
tell
you what you're looking for.
Yeah.
Yes, I can show you exactly what to look for with the W-9. Let's see, and pull this up. Share my screen again. All right, let me know when you can see my screen.
I can see it.
All right, perfect. So this is a W-9, it's request for taxpayer identification number. So of course they're going to put their name or business name in the first 2 blanks. Here, section 3 is what you want to pay attention to. So individual gets a 1099. Any corporations do not get 1099. So if they complete this and they mark C Corp or S Corp, they would not get a W-9. I mean, they would not get a 1099. Partnerships get a 1099. If they're an LLC, but they're classified as a C or S Corp, they do not get a 1099. If they're a partnership, they get a 1099. So the general is corporations don't generally get 1099s, but you need a W-9 from them to make the determination. Yeah.
Okay.
So quick question, and I may have missed it. So if you pay a corporation and you're not able to give them a 1099, what do you give?
So if you're paying a corporation, you know their corporation, they gave you a W-9, right?
Yep.
You want to know, what do you get?
What do we give them?
Nothing at all. You don't get them anything. Just because so technically corporations and S Corps are exempt from 1099s because they should have sophisticated systems that tracks all of their revenue. So you don't have to, in general, that's the general rule for most businesses. The 1099 is just an information reporting document. Generally, you're supposed to keep up with your own revenue for the year so that if you don't get a 1099, you're still able to report all your income to the IRS. So let's say you did business with someone and they gave you a 1099. But they didn't give it to you till May, and you did your taxes back in March, right? The IRS is going to get that 1099, and if you fail to exclude that income because that 1099 was way more than what you reported in your tax return, you're going to get red flags. So that's what I say it's important for you to keep up with all of your revenue because at the end of the day, the burden is going to fall back on you.
So let's say that I hired a company and they did some yard work. $20,000, and I'm deducting that from my income as a money
Yep.
that I paid out.
Uh-huh.
If I don't do a 1099 miscellaneous, would that be, I mean, is there any other category where I can put it? Contract labor or?
All right, so this is for your business. They're doing work for your business.
Yes, ma'am.
All right. And they're not a corporation, or they are a corporation.
They are.
All right. So you don't, they wouldn't get a 10. You can still deduct it in your business because it's a legitimate expense. You just don't issue them anything to them to show that you paid them. That's not your burden to tell them what you paid them. That's their burden to tell the IRS what they got paid.
So I would still deduct that somewhere.
Yes.
I just don't have to file the 1099.
Exactly. You still can deduct it as contract labor or landscaping maintenance, but you don't have to inform them that you paid them $10,000. They know that already, or they should.
Thank you.
I got a little bit late to the call, and you were talking about the miles or the car, what to do with the car. Is there any way you can talk about it a little bit?
Yeah. All right. So business mileage, I talked about that a little bit earlier about deductions. So someone asked about app to use for business miles. So I recommend MileIQ as a great app to track your mileage because it stays on your phone wherever you go. If you stop, it's going to say, hey, was this a business trip or a personal trip? You mark it business, it documents the mileage for you. And you also can put in notes telling exactly what the business trip was for. So the way mileage work is, of course, you know that the IRS has a standard rate that they publish every year on what you can take per mile. So with that, they want to know 3 numbers. They want to know your total miles for the year, your business miles, and your commuter miles. Only thing that's deductible are your business miles, but they also want to know the percentage use of the vehicle, meaning they want to say, well, if your total mile was 10,000, but your business miles were 5,000, that means 50% of the vehicle was used for business use. And they'll give you the deduction 5,000, whatever that rate is, as a deduction on your tax return. Business mileage is the deduction that keeps on giving because unlike actual expenses, you can continue to take business miles no matter how old your vehicle is, no matter if you owe money on or not, versus actual expenses where you can take a big deduction right away, but eventually the deduction goes away over time. And with the IRS, you can go actual to mileage, meaning you can convert a car that you're using. I mean, not actual mileage, you can go from mileage to actual. You can convert a car that you're using from mileage to actual expenses, but you can never go from actual expenses to mileage. So that's why I always encourage small business owners to choose the mileage deduction. It's a little more paperwork because you gotta have a mileage law that you keep up with, but it's gonna pay off a lot more in the long run.
So if I were to get a business vehicle, do I still need to do that? Keep up with the mile? I mean, can you?
Yes.
How would it?
Yes. So generally, if you buy a brand new truck or car in your business, you want to try to title it in the business name. Of course, get the business insurance to cover it. You can take actual. Actual is going to give you the most bang for your buck immediately because, again, if you buy a $50,000 car, you will take a big chunk of that as a deduction in year 1 based on the depreciation rules. However, it'll get smaller and smaller over the next 5 years because most vehicles have a 5-year asset life. And then you won't have nothing else to deduct other than some interest payment if you had a loan. Versus mileage, you may not drive a whole bunch of miles that first year, but you'll have that car for 10, 20 years, and you'll still be able to take that mileage deduction for as long as you have the car. Now, the IRS wants you to keep track of a mileage law because they want to say, okay, yeah, you say it's for business, but you still drive home in this car. Meaning everywhere you drive in this car is not business. So we need to understand how much of that is actually business mileage versus how much of that is actually personal mileage. And that's why they want you to keep a mileage law regardless.
Okay.
Yeah.
Thank you.
Can I ask a question about the car? I'm piggybacking on it.
Sure.
Everybody here today. Do you recommend an application where we can track things like that? I have heard, but I don't have any names of people that say, Well, there's an application that tracks where I'm driving, and
Yep.
it knows how long it is, and I just mark it personal or work.
Yes, that's Mile IQ. I just mentioned that. The app is called Mile IQ.
Mile IQ. Okay.
Yes, yep. That's the app that will do that personal or business tracking for you.
And Nicole, I got a question about
Yes.
the consults and tax professionals.
Yes.
What you recommend for a small business of how do you evaluate of, hey, is this the right tax professional for me?
Yeah.
That's one question. The follow-up afterwards is, hey, now that you have a relationship, what are things that that tax professional should be doing to look out for your best interest? Obviously, you're giving a lot of hot tips today.
Yeah.
And beyond a small business contacting them as needed, having these types of dialogues, how can a small business help facilitate that, get the most out of the mileage? Literally, I know we just talked about that with their tax professional.
Yeah, sure. All right, so I always say your best way to find someone reputable or trustworthy is to ask your referral network. They usually know someone that they love and trust, and so they can recommend someone to you that will work in your best interest. If you don't have someone you don't know someone that can refer you to someone, I would say start local. Look in your Google reviews, see what local companies that have great reviews from customers that love working with them. That's next. Just making sure that there aren't any red flags, because there are so many tax professionals that will get you in hot trouble, and you want to avoid that at all costs. I would say you want to make sure the tax professional is of course, forthright and forthcoming with you about the tax laws, that they're communicating any tax law changes with you. That could be through a newsletter that they have, that could be through webinars that they're hosting, that could be through personal consults, that you just have something that you need to run by your tax professional, and they will set some time aside to kind of work through your specific facts and circumstances to give you the best advice. So definitely start with your referral network. Then if that doesn't work, start looking locally through just a simple search on Google. Look at the reviews of people that other people trust. And then, of course, make sure they're working in your best interest. Make sure they're being fair and charging fairly. Because some companies will charge outrageous amounts, but at the same time, you want to make sure that you're hiring someone that is going to be accurate and professional. And that usually doesn't come cheap either. So you don't want the cheapest person either, but you also don't want somebody that's going to charge you $50,000 just to make up deductions for you. Again, avoid people that are not going to do the right thing. All right, any other questions? We got 2 minutes left. Just 2 minutes.
Oh, I just had one quick follow back up to the W-9. Do you have to get a new one each year? Like based on
you do not. It's just a one-time thing usually, unless of course the business changes their tax election structure or they change their structure.
Okay.
But again, that's really hard to know unless they tell you all their business. But usually one time is enough.
Okay, thank you.
I do have a comment. I have been able to do like a file, an extension, because sometimes my the kind of company I have to wait to see what my company does because it goes to my personal. So I file an extension, and that actually saves me from having to pay a whole lot of late fees or anything.
Yes.
And it gives me a little bit of extra time to get everything ready.
Absolutely. Extensions are your friends. People are afraid of extensions, but extensions are actually encouraged, because again, like Pilar said, it gives you more time to get your books in order, to kind of make sure you didn't miss anything. Remember, an extension only extends the time to file, though. It never extends the time to pay. So if you owe the IRS, you still have to pay by the original due date, which is 4/15 for individuals and corporations, C corporations, and it was 3/15 for S corps and partnerships. So generally, you don't pay taxes at the S corp and partnership level either, though. So that's something to keep in mind. All right, Michael, I'm handing everything back over to you and Jason.
Well, thank you.
One last question before you go.
Okay.
You just said something I wanted to ask you about. You said, what was your opinion on, or if you just hit on a high level, pros and cons of S corp, C corp?
Okay, very quickly. All right, so S Corp generally, S Corps are not recommended unless you're at a certain profit level, just because there's so much compliance around that. And they don't pay taxes at the entity level, meaning all the taxes from a partnership or S Corp are passed through to the business, and the owner pays taxes for that business on their personal tax return. Whereas C corporations are taxed at the entity level. That means they get taxed at whatever rate is applicable at that time. Right now, the tax rate is, I think it's 21% for C Corps. And that because under the Tax Cuts and Jobs Act, which is the law that was passed by Trump, he reduced that corporate rates all the way from almost 40% all the way down to 21%. So. Did I answer your question, Josh?
Yeah, as compared to a LLC partnership, I think what would be the key factor to switch from that?
Great question. All right, so if you're currently LLC, you can generally elect to the IRS how you want to be taxed. So you can say, I'm an LLC, but I will be taxed like a C Corp, meaning you're going to pay tax at that 21%, and it scales based on, I think, as the company grows. And you're going to pay taxes at the entity level only. Or you can say, I'm an LLC, but I want to be taxed like a partnership, or I'm an LLC, I want to be taxed like an S Corp. Again, partnerships, taxation rules are a little different because it depends on the types of partner in the company. S Corps are taxed at both ordinary income rates and also capital gain tax rates. So again, that's a little more complex, but generally, again, you don't want to let S Corp right out the gate. A lot of people let S Corp right out the gate, and it's not the best move for your business, especially if you're going to have a loss, because that loss is going to work against you unless you have something called basis in the company, which is like positive equity. If you don't have enough basis in the company, you can't take the loss. So you're just accumulating this loss. Whereas if you were an LLC, or partnership also have basis, I should say that. But if you were LLC, single member LLC, you can take that loss on your Schedule C business. And then when you start being profitable and you see where your profit increases, it may make sense to have a conversation about converting to an S Corp. I know that was a lot. So that conversation is a whole webinar all by itself, because there are so many different pieces that go into electing the right tax election for your company.